Good morning, everyone. My name's Ing, if we haven't met before. I'm from Dartmouth, not Michigan, as the program suggests. But I'm here today to talk to you about whether or not managers do good with other people's money. This is joint work with Kelly, who's sitting right over here, and Harrison Hong, who sends his best. He recently had his baby, so couldn't come. Now, if you go to the website of any Fortune 500 company these days, you'll likely find a section on sustainability and responsibility. And the truth is many corporations these days spend significant resources on CSR, or corporate social responsibility. For example, in 2014, at least according to one consultancy, Fortune 500 companies spent a combined $15 billion on philanthropic activity alone. Now, corporate social responsibility can span many types of activities, not just philanthropy. For example, there can be investments in green technology, more socially responsible products, better labor practices, or at least more employee-friendly labor practices, and initiatives that promote diversity. So just as some examples, Google, when they went IPO, initially promised to spend 1% of their profits on CSR. More recently, they're a carbon neutral company. Intel and General Electric spend several $100 million every year contributing to their company-sponsored foundations. CVS recently renounced the sale of cigarettes. Starbucks has been constructing LEED-certified stores, and the list goes on and on. Now, why do companies do this? I think there are roughly two views. The first view is that companies do well by doing good. And this was reviewed by Benabou and Tirole in a nice paper in 2010. And the basic idea is that CSR is a win-win. It's good for society, and it's also good for shareholders. Corporate social responsibility may improve employee retention. It might mitigate regulatory risk. It might signal product quality, improve investor and customer loyalty. And there are lots of different explanations that I think sound very plausible. Milton Friedman actually pioneered an explanation going all the way back to 1970 that corporate social responsibility is in fact symptomatic of agency problems. And there's a famous quote in his, it was an op-ed for the New York Times, where he says, there is one and only one responsibility of a corporation, and it's to increase profits. And the basic idea is very simple. To the extent that the manager spends money to promote the general social welfare, if that's not correlated or if that's not in shareholders' interest, that's bad for the firm. Now, the literature has studied CSR in economics and management extensively. And the literature has focused largely on whether or not there is a relationship between financial performance and CSR. Financial performance, you can think of various different measures you want. There was a review paper by Margolis in 2009 that looked at 260 studies and roughly concluded that there is a small positive correlation between financial performance and CSR. Now, I think it's very hard to disentangle cause and effect from a lot of these, in a lot of these studies. But nevertheless, I think this is the lack of conclusive relationships either way has given rise to a potential third view that CSR is essentially inconsequential for firm value. So what do we want to do in our paper? We want to ask, well, how does the marginal investment in corporate social responsibility react when managers receive a positive shock to incentives? That is, if we were to take the Milton Friedman theory seriously, and you were to think, okay, suppose I exogenously strengthen managerial incentives, what happens to CSR? Okay? And typically we think of an agency problem as a selfish perk, right? It's empire building, it's buying a jet with corporate money, but our perspective is a little bit different, or we take a broader perspective, I should say. We want to take seriously the possibility that agency problems can manifest as social preferences or altruism. So a manager may want to be more philanthropic. The manager may want, it may make the manager feel better to construct LEED-certified stores, and so on. In essence, we want to ask, do managers do good with other people's money? So what do we find in our paper? In some sense, the headline result or the core result is that we find that agency leads to overinvestment in CSR. So in two quote-unquote natural experiments, strengthening incentives leads to less CSR. I'll tell you more about the experiments as we get into the body of the paper, but the first experiment is the 2003 Dividend Tax Cut, which we argue increases management's after-tax claim to the profits of the firm, and thereby reduces or strengthens incentives and creates and leads managers to reduce agency problems. The second experiment we're going to build on is off a paper by Kunyat and co-authors in 2010 that examines the close passage of shareholder-initiated proxy proposals. And the basic idea here is that a shareholder-initiated proxy proposal, when it passes, it essentially increases monitoring on management. And if you were to compare proposals that just passed versus proposals that just didn't pass, that is in some sense an all else equal comparison where incentives were strengthened. Okay? Now, we're also going to explore, and I use the word explore, consequences for firm valuation and welfare. We find that there were the strongest returns after the tax cut for firms predicted to reduce agency problems the most, and that this signals that these firms actually experienced increases in valuation. Now, we have a caveat here is that in the sense that we don't attribute these returns only to reductions in CSR in the following sense. In each one of our experiments, agency problems are mitigated. Now, that's going to increase firm value. We can't pin down exactly how much of that firm value increase is due to just the reduction in agency problems coming from reduction in CSR, because other types of agency could be mitigated at the same time. However, we think this is a valuable exercise in the sense that if you were to go back to the results in the literature, which finds a small positive endogenous correlation, here what we're observing is that when incentives are strengthened, the firms who are predicted to reduce agency problems the most cut CSR, right? So they reduce CSR and yet experience positive returns going forward. So that's in some sense different, very different from the literature. So Friedman, we think, was right in one sense. CSR is important for the firm because of agency problems. However, we go on to ask whether or not there's, in some sense, a trade-off between firm value and welfare. So implicit in the Friedman critique is like almost an M&M idea, right? Jonathan's favorite. So in fact, in his article, he spells it out. He says the stockholders, right, could separately spend their own money on the particular action of corporate social responsibility if they wish to do so. So his view was that CSR is just a pure cost to society, right? In the sense that it's an agency problem in the firm, and there are no welfare effects, or if anything, positive welfare effects if companies cut CSR, since households are going to offset that cut, and kind of the firm will have less agency problems. Okay. Now we're going to try and shed a little bit of light on whether or not this was true, at least in philanthropic giving. And we're going to argue that this proposition is unlikely to be true in our setting. So we're going to estimate a lower bound on the causal effect of the tax cut on corporate philanthropy, and we think that's several hundred million, quote unquote, missing dollars in 2003. That is, after the dividend tax cut passes, we see causally, or we argue causally, corporate philanthropy dropped by several hundred million dollars. We're going to look at philanthropic giving by the richest households as measured in the Survey of Consumer Finances in 2000 and 2003. We're going to argue that the trend goes the wrong way. If you think that these households, that there was an offset effect, if anything, you should observe giving by the richest households, who are the most likely to own stocks and are experiencing these valuation increases. They should be giving more to offset this decline in corporate philanthropy, but the aggregate trend just goes the wrong way. Giving actually falls between 2000 and 2003. So we think, broadly that while Friedman was right in one sense that CSR is important for agency, there's a potentially novel perspective here that there might even be a potential trade-off between governance and social welfare. To the extent that CSR may mitigate the underprovision of public goods, we may actually want firms to do CSR even if it's part of an agency problem because of the public good problem. But that's, I'll get to this when we get deeper into the results. Okay. So what are our experiments? Our first setting is the dividend tax cut of 2003, which cut the dividend tax rate from 35% to 15%. Now, just a little bit of history. This tax cut was initially proposed in January of 2003, and it actually passed in May 2003 with high political uncertainty. Vice President Cheney had to cast a tie-breaking vote in the Senate in order for the broader bill to pass. Now, after this, firms increased and initiated dividends, especially high insider ownership firms. So this was documented in a series of papers by Chetty and Saez. There's some debate as to whether or not what happened to aggregate payouts. For our purpose, for our setting, this is actually not a crucial kind of element. Whether or not it's not crucial for us whether or not aggregate payouts went up or down, as you'll see. As you'll see. But our claim is that the dividend tax cut strengthened incentives by increasing managers' after-tax claim to profits, and the logic is very simple. Managers are highly exposed to the dividend tax cut, often because this represents, their shareholdings in the firm represent a significant portion of their wealth that can't be easily filtered through kind of tax advantage accounts. Now, the important observation for us is that while the tax cut hits every firm, the effect for each firm is proportional to how much the manager owns in the firm. If the manager owns nothing in the firm, the dividend tax cut essentially doesn't affect my incentives at all. So what this is going to end up predicting, as I'll show you in a second in our model, is that firms with moderate or medium insider ownership stakes are going to cut agency problems, and the test is whether or not CSR is an agency problem. They're going to cut kind of bad projects the most relative to low and high insider ownership firms. And here's the model on one slide. And somehow it got a little distorted in the projection. It's OK, I'll try and talk through it. So the model is a simple one of agency and investment choice. It's basically adapted directly from the Chetty and Saez model. Managers are going to choose K, G, and D, subject, which is kind of spending on a productive project, spending on an unproductive project, and paying out dividends. And they're sitting essentially on a big cash pile, gamma. Now, K is positive NPV. It gives you gross output, F of K plus K. There's a first best in this. There's a first best amount of capital spending in this model. G is negative NPV in the sense that the gross output is just G, and the manager captures G of G. Okay? There's no uncertainty in this very simple model, so the discount rate is just the risk-free rate. That's the sense in which the G is negative NPV. The manager pays out D as dividends taxed at rate taus and owns fraction alpha of the firm. So if you look at this objective function, what is the manager doing? Essentially, the manager gets alpha times 1 minus tau, right? So he owns alpha of the cash flows, taxed at rate, effectively at rate 1 minus tau, times essentially the total payouts of the firm, dividends plus remaining payouts the next period, plus he gets essentially this private benefit the next period. Okay? And the key observation here is that the lower the tax rate, the higher the effective ownership in the firm. So if he owns alpha percentage of the firm, when the tax rate goes down, alpha times 1 minus tau goes up. That is relative to kind of investing or doing productive things. When the tax rate declines, he's going to assign a lower weight to private benefits. Okay? So the key prediction that you get out of this model is that in response to a dividend tax cut, medium ownership managers with alpha in some intermediate range cut goodness more than low ownership managers and high ownership managers. And then the intuition is as follows. I think the low ownership managers case is simple. So low ownership managers are relatively unaffected by the tax cut. Just imagine if I own nothing in the firm, the tax cut just, I don't care, right? Medium ownership firms reduce G aggressively and are going to substitute towards capital spending and potentially higher dividends. That's where they kind of move the cash. Now, high ownership firms in the model have low agency problems to begin with, and so there's just not very much scope to reduce G relative to the medium ownership firms. And that's where this U-shape essentially comes from. The medium ownership, the effect of the tax cut is increasing in the ownership spectrum. However, high ownership managers essentially are very efficient to begin with. There's very few unproductive projects to cut, and so you're going to get the prediction that medium ownership firms are going to cut unproductive projects the most. And so the suggested difference in difference test predicated on these quote-unquote heterogeneous treatment effects. We're going to sort firms by their pre-tax cut managerial ownership stakes and compare the change in CSR across firms going forward. And the question that we essentially want to ask is, does the marginal unit of CSR act like G, K, or K in the model? Or do we just see nothing, right? So it's an empirical question. We're going to focus on S&P 500 firms. And we're going to, our key left-hand side variable are going to be these KLD scores of corporate social responsibility. Now, KLD has the most comprehensive historical coverage, company by company, of corporate social responsibility. I emphasize that these are scores. Unfortunately, they don't have dollar amounts attached to them. But what KLD does is every year they score companies on strengths and concerns of various categories, where the community efforts, community relationships, diversity efforts, employee friendliness, how environmentally friendly you are, and how socially responsible your products are. We emphasize that these KLD scores, I think a legitimate complaint is that they have a little bit of a black box element to them. We think it's a noisy left-hand side variable, but this doesn't bias our estimates. We also think that just the fact that actually many companies peg their investment strategies to these scores signals that they actually follow something. And I'll show you a little bit, just a graph, to show you that they seem to do a good job of picking something up. We're focusing on S&P 500 firms mostly because KLD expands their coverage through time, and the most consistent coverage is with S&P 500 firms. Okay? And what we're going to do is we're going to rank ownership by average 2001 to 2002, top 5 total insider share ownership as a fraction of shares outstanding, and then just run the diff and diff and see what the data tells us. Okay? So here's just a graph of KLD scores. So time is on the horizontal axis. The KLD scores run back to 1991. Here's the S&P 500 average. The way the scores work is the higher score means you are kind of like a better firm. You do more CSR, and a lower score means you do less CSR. Okay? Now here in the circular dots is Apple. Now Apple starts off in the sample as being a very good firm, but Steve Jobs comes back, and Steve Jobs famously kind of also believed that the only responsibility of Apple was to make profits. And when Steve Jobs comes back, the scores plummet significantly. Google, on the other hand, these diamond scores, starts off with a score that's already above the S&P 500 average, and then rises as they adopt more of these initiatives that are socially responsible. So here's just some examples that I think correlate the KLD scores with some anecdotes. I should mention that we're not the first people to use these KLD scores. They've been widely used in the literature. So the equations are not showing up properly. But essentially, I can skip, I guess, to just here. Well, I'll try and explain it. I apologize for the equations not showing up. So each year we observe we're going to run a diff and diff. Our left-hand side variable is going to be the KLD score. And on the right-hand side, we're going to have firm fixed effects, year fixed effects, and then just a series of interactions between ownership quintiles and whatever year it happens to be. We're going to include various controls for firm size. But this coefficient gamma is essentially the key coefficient. It's the cumulative difference in difference of CSR at the end of year T minus CSR in 2002 for ownership quintile J minus the middle quintile 3. So we're taking the quintile 3 as the middle ownership bucket, and we're going to examine as time goes by how CSR evolves for the different quintiles relative to quintile 3. Okay? Now, the agency explanation essentially predicts that these coefficients are positive after the tax cut. That is, that after the tax cut, CSR for quintiles other than the middle ownership quintile is growing, right? Because the middle ownership firms should be cutting CSR relative to the other firms. Now, any alternative has to affect medium ownership firms more than high or low ownership firms, specifically around the time of the tax cut. So here are the results, right? So here's year, kind of running down in rows. And in the first column, we have year effect. So this is essentially the effect for medium ownership firms, how CSR is evolving for medium ownership firms through time. Up until 2001. 2002 is the omitted year. It's the base year. Everything changes relative to 2002, right? So it's a little bit flat, running up until 2002. Then starting in 2003, CSR starts to decline. So in 2006, average CSR for the medium ownership firm has declined by a full point. Now, one standard deviation I should mention in the data is roughly 2.5 KLD points. So kind of that's the economic significance. For medium ownership firms, they've declined by a full point relative to their 2002 baseline by 2006. Now, if I look at the diff and diff for quintiles 1 and 2, what you see is that quintiles 1 and 2, they have been, in some sense, relative to quintile 3, growing their CSR by about 0.5 and 0.6 points by 2006 cumulatively, right? So by 2006, essentially CSR for quintiles 1 and 2 has grown by a half point relative to the middle ownership quintile. And if you look at the higher ownership quintiles 4 and 5, you can see that CSR has grown by even more. So it seems like quintile 3 is doing a lot of aggressive cutting, right? In the sense that quintiles 1, 2, 4, and 5 by 2006 all have significantly higher CSR than quintile 3. This could potentially just be an artifact of how we've cut quintiles. I'll show you some non-parametric analysis in a second that gives you a fuller picture of what's going on. If you do everything in deciles and just compare the evolution of CSR for the lowest ownership decile versus the combined 5 and 6 decile, and also the highest ownership decile versus the combined 5 and 6 decile, here's what you see. So these are the diff and diff coefficients running up to the tax cut. So you can see up until the tax cut, there's very few pre-trends or differences in trends in how the lowest ownership and highest ownership deciles are reacting in CSR relative to deciles 5 and 6. But then after the tax cut, essentially the low ownership firms and the high ownership firms, their CSR ends up being much higher, especially by year 4, relative to deciles 5 and 6. Okay? So it seems like the middle ownership firms are reducing their CSR relative to these outside quintiles. So like I said, there's few pre-trends in the CSR across ownership groups. The economic magnitudes are large. They're roughly a quarter or a third of a standard deviation. You can kind of do artificial tax cut years, and there's no effects for if you just pick a different tax cut year. You can look at how these, what subcategories of KLD scores these effects are concentrated in. So what are medium ownership firms cutting? Are they cutting environmental friendliness? Are they cutting their are they being mean to their employees? And basically what you find is that they're cutting environmental projects and they're being meaner to employees. Okay, and that's consistent with our discussants' results. Okay. Okay, so here's just like some non-parametric kind of pictures of what's happening. So here on the horizontal axis, I have the ownership percentile of firms ranked in 2001 through 2003. So I'm holding that ranking constant. And on the vertical axis here, I have the KLD score in 1999 minus the KLD score in 2002. So 2002 is always the benchmark year. And in 1999, you can see it seems like low or high ownership firms, maybe if anything, have lower CSR, but really relative to in 2000, you can kind of see it's flat, right? So basically, firms in 2000 look like they have very similar KLD scores. 2001, it's flat. 2003, I don't know, it's a little bit more wiggly. And as you click along, you see a bigger and bigger U-shape start to develop, such that by 2006, it looks like the lowest ownership firms here they've increased their KLD scores, right, or relative to kind of this middle section. So firms, let's say, with the ownerships in the bottom 20%, right, this is how much they've cut their KLD scores. Firms in the top 20%, this is how much they've changed their KLD scores. Firms in the middle here, or at least slightly off to the middle, have cut their KLD scores the most aggressively relative to the firms on the outside, consistent with the model's predictions. Okay? So what happens to returns? We're going to ask, well, do these middle ownership firms also have the highest returns post-tax cut? And we're going to look at long horizon cumulative abnormal returns computed with betas in a 1 year leading up to the tax cut. We're going to examine cross-sectional differences in average stock returns. For those of you that kind of pay careful attention to this stuff, there's a lot of kind of, you have to be careful about equal weighting versus value weighting, kind of cross-stock correlations. We do a lot of stuff in the appendix to address all these concerns. But essentially kind of a bigger caveat that I want to highlight is that we don't necessarily associate all returns with cuts in CSR from this exercise. So in some sense, what we're asking is, once the tax cut comes, do medium ownership firms experience the highest returns? They could experience highest returns because of reductions in all types of agency problems, not just CSR. So in that sense, the magnitude that we're observing is not just coming from cuts in CSR. Nevertheless, I think it's a valuable exercise in the sense that, as I mentioned before, the endogenous correlation between CSR and firm valuation is, if anything, positive. And here, what I'll show you is that we observe that our shocks to governance essentially cause firm valuation and agency-induced CSR to move in opposite directions. Jonathan says 5. Good. Okay. So here's the picture. Here's kind of the cumulative abnormal return starting in T-minus 31 days, calendar days, going out to 360 days out. Here, this top line, it turns out to be green. Actually, I can't tell immediately, I think because of the lighting, what color it is. But here, the top line, after 1 year, turns out to be exactly kind of the middle ownership quintile. Relative to, let's say the next line down is quintile 4. The next line down below that is quintile 2. and here it's quintile 1, and here's quintile 5. So you can see this is the evolution of returns through time. It just seems like after a year, the medium ownership firms have done a lot better than every other quintile. And I think the striking thing here is that the pattern of returns just lines up remarkably with the pattern of changes in KLD. So here I have deciles in ownership portfolios, so 1, 2, 3, 4. I've omitted 5 and 6 because I'm going to show you these are on the vertical axis are the returns of each one of these portfolios minus the returns of the middle ownership portfolio, the combined 5 and 6 portfolio. And then here's 7, 8, 9, 10. It seems like here, well, actually, I got this labeling the other way around. It's 5 and 6 minus the returns of J. So here, 5 and 6 are going to outperform after a year quintile 1 by roughly 17%, and quintile 5 and 6, or deciles 5 and 6 outperform decile 10 by a remarkable 27% after 1 year. Okay? And the point here is you see this U shape that just lines up remarkably well with changes in the kind of how the KLD scores evolved, as I showed you in the non-parametric analysis. Okay? So corporate philanthropy, we're going to look at whether or not private giving makes up for the shortfall in CSR. And essentially, we're going to compare the missing corporate giving from the tax cut experiment to changes in aggregate giving by the wealthiest households. I'm running a little short of time, but I just want to note that we did a little bit of hand collection of foundation tax return data. That's where we get numbers on how much corporations give to their foundations each year. And what we're estimating is essentially a lower bound for kind of total dollar cuts across CSR. So if you look in this panel, here's some summary stats. On average, firms give about $10 million to foundations each year. The middle ownership firms gave about $4 million each year in the pre-tax cut years, and roughly the same amount in the post-tax cut years. The low and the high, actually increased their giving, right? And this is going to add up in the diff and diff to an effect where you see lower ownership firms and higher ownership firms. It's not statistically significant for the highest quintile, but the point estimates suggest that if anything, medium ownership firms grow their giving at a lower rate than the lowest and the highest quintile ownership firms. And so that's going to tell us, if you work out the back of the envelope calculation, that essentially the causal effect of the tax cut is leading kind of several $100 million of giving to go missing. Now, if you look at aggregate giving in the Survey of Consumer Finances, what happens is that kind of aggregate giving by the top 8% of the households in the population in 2000 was $131 billion. And in about the same top 8% of the population in 2003, aggregate giving drops to about $112 billion. So it looks like here, both households and corporations are cutting giving between 2000 and 2003. It just doesn't look like, it seems like there's at least obvious evidence that households are increasing their giving to offset declines in corporate giving. Our second experiment it revolves around the Cunha, Gini, and Guadalupe paper in 2010. We look at whether or not shareholder proposals with vote shares slightly in excess of 50%, essentially when these votes pass, whether or not firms cut their CSR relative to cases where the votes just don't pass. And here I'll just, I'll skip to, in some sense, the main result, since I'm running very low on time. Jonathan says 1 minute. Great, thank you. Which is that if you fit local kind of linear or local polynomials around the 50% cutoff of whether or not a vote to strengthen governance at a firm, let's say to increase independent directors or cut down on anti-takeover provisions, when that vote just passes, let's say in the 50 to 51% bucket, if you compare that to cases where the vote just doesn't pass, let's say in cases where the vote share of pass was 49 to 50%, scores fall by approximately 0.6 points. So this is consistent with the general implication of the model that when you strengthen agency at a firm, managers are going to, when you strengthen incentives at a firm, managers are going to reduce agency problems. And here it looks like KLD is an agency problem, right? It's reacting just like we would predict an agency problem, just like how we would predict agency would react. Okay? All right, so here's just the picture. Here's 0 is essentially 50%. Here's the effect to the left of the 50% cutoff. Here's the effect to the right of the 50% cutoff. There's a little bit of kind of movement just around the 50% cutoff, but if you just look at this space right here, KLD grows for firms to the left relative to firms to the right. So that's the main RD result. So our conclusion is, On the margin, firms engage in CSR due to agency problems, in the sense that when we strengthen shareholder incentives in our two experiments, that leads to reductions in CSR. And our conclusion here is that the marginal unit of CSR is driven by agency. Now, I want to stress the word marginal. As with any natural experiment, we can only identify how the marginal kind of unit of CSR is going to react. We're not making a statement about how CSR, whether or not CSR on average is a productive project or not. 2, we see the strongest returns after the tax cut for firms predicted to reduce agency the most. And so we think so far Friedman was right, but potentially there's a trade-off between governance and social welfare in the sense that we just don't see households, or any obvious evidence, I should say, by households making up, giving by households making up for the missing dollars in corporate philanthropy.